All right, everybody, we are here for the January market update. We are going to be taking a look at some key metrics that are happening within the market, and we're going to be taking a look at also some economic factors that are changing. So a couple really interesting things that are going on right now. I'm looking to see who's joining. I'm going to be keeping my eyes on the chat. Now, I'm going to be posting this video on YouTube afterwards, so don't say anything you would not want your mother to hear, because this is going to be on YouTube later. My name is Alex Fenske. I'm the team leader here at Keller Williams Elite in Oak Lawn, and I've been doing these market updates since COVID hit and things were changing. We used to do these, I think it was every day, and then we dialed it back to a couple times a week, and now we do them once monthly because things just aren't changing quite as fast, thankfully. So there's certain key metrics that I want to touch on. It's not everything. There's 4 different things that I focus mostly on when I am studying the new market numbers at the end of each month. And the first one is homes for sale. You might also hear this called inventory. And that's just the number of homes that are available right now and not under contract. So this is actually one of the changes for this month. And it might not be what you think. As of the end of January, there were 13,858 homes for sale in our multiple listing service, which covers all of Northeastern Illinois. 13,858 for sale. Now, that is another new record low. The month before, it was a little over 15,000, about 16,000, and that was a record low. So now we're at another new record low in terms of homes for sale in our multiple listing service. And believe it or not, there's only half of the number of homes available right now as there were just in this past September. So just a few short months ago, there were literally twice as many homes for sale. And that wasn't peak of the season. That wasn't summer. That wasn't spring when all the listings are coming on. That was in September. There's only half that many now. So the inventory woes have only tightened even more. And I know we didn't think they could. They have. It's going to take time for that to get back to any kind of a reasonable level. It's not going to happen right away. And these other metrics are going to show you why that's not going to happen right away. The next one that I look at is the number of new listings. So this isn't the number available. This is the number of new listings that came on the market in the month of January. And that was 11,187, which was a big jump over the prior month, December. That's typical. New listings always jump up a bit from December to January. December is usually the lowest. However, the number of new listings was actually down 22% compared to last January. So it was about 13,000 or so in January of 21. And of course, that number was lower than it was the prior year and the prior year. It's been going down for several years now. So most of these updates, the last few months, year, if you will, the number of new listings compared to the prior year has been lower, but usually on average, about 8% down. This number is down 22%. So there were not that many listings that came on in January, and that's part of what contributed to the inventory hitting another record low. Next up is pending contracts. This isn't how many contracts were written. This is how many were in pending status at the end of the month. And at the end of January, there were 10,137 pending contracts, which, again, is up from December, as it typically is. But it's down about 7% from last January. So there weren't as many pending contracts. I think it might have something to do with there not being any homes available, because we're at a record low inventory and 22% fewer listings came on, like we were just talking about. So you have to imagine that there's some pent-up contracts because there just is very little to choose from. That number, though, of pending contracts is still up by double digits over the prior years. So it's still up double digits over 2020, 2019. So rest assured, pending contracts are still healthy. They just weren't quite as high as they were last year, and I suspect it has a lot to do with the limited inventory. Lastly is closed sales. Closed sales is a lag measure, meaning that's the last thing that happens And all that other stuff we just talked about are the signals of what's going to happen with closed sales. But it's worth looking at anyway because that's the end of the game. I mean, that's what all this is about is our clients that are closing on the purchase or sale of a home. So closed sales are usually down in January compared to December, and that's no exception here. It's the same thing happened this January. It's flat over last January, same number of closed sales, and that number is still up over 20% compared to the prior years, 2020, 2019. So we're still closing way more sales than we typically are. We're still writing way more contracts than we typically are. And there's even fewer homes available than there typically are. I would say the biggest change in this month's report is that inventory at another record low, second month in a row for a new record low inventory. I would say that's the biggest change in the market information. So for everybody that's going, when's this going to change back around? When are we going to head the other direction, back towards a buyer's market or a balanced market first? Unless there is a catastrophic change, that's not going to happen immediately. You need to build back from 14,000 homes for sale up to where you get at least 30, 40,000 homes for sale before you even begin to think about a balanced market. And even then it wouldn't be. You'd still need more. So that's where we stand with market metrics. I'm watching the comments. Thank you, Snow, Kelly. I see you guys there. If you guys have any questions about market metrics, ask them now, because now I'm going to go into the economic changes that are happening right now. So I'll give it a couple seconds here, see if anybody has any questions about market metrics. And then we're going to talk primarily about mortgage interest rates. Oh, yeah. Okay, seeing none, I'm going to go into mortgage interest rates. So this is an absolute change in it. We've been talking about it for the last couple of months because the Fed really changed course on what they were doing with their policies a couple months ago compared to what they had been planning to do for quite some time. Their most recent meeting of the Federal Reserve Open Market Committee was at the end of January. It was the 25th and 26th, just about a week ago. And at that meeting, there was nothing surprising. They basically reiterated what they had already said they were going to do at their December meeting. It's December that was a change, and in January they said, yeah, we're still sticking with what we said in December, which is this: they kept the overnight borrowing rate at a range of 0% to 0.25%. Everybody likes to talk about the federal funds target rate, and it doesn't have a direct impact on mortgage rates. The federal funds target rate is the rate at which banks in the Federal Reserve System can borrow money overnight. So it doesn't have a lot to do with interest rates other than its indirect effects on the economy. What has a bigger effect on mortgage rates is bonds, the bond market for treasury bonds, and the mortgage-backed securities market. And that's where the big changes are right now. What they are doing right now is the Fed. Let me take a step back. When the Fed wants to inject money into the economy, they buy stuff. They buy bonds and they buy mortgage-backed securities. And by doing that, they are paying money into the economy and they're taking other assets out of the economy, bonds and mortgage-backed securities. So when they want to stimulate the economy and they want to inject cash, they buy. And they've been buying at an aggressive rate all the way back to when COVID first happened. They're tapering that down, and they're going to be done with that buying within early March. They specified early March at this most recent meeting. And so, Angela, I see that you said, "Hey, what's up with the bond purchases?" Yeah, this is happening now. And Angie, I'm going to come back and answer your question about the market crash thing. So the bond buying, they said in December they were going to taper it and they would be done in March, but they didn't say when. Now they're saying early March. They're going to be zero at that point. They will be down to zero purchases of treasury bonds and zero purchases of mortgage-backed securities. Whereas right now they're buying 20 million of the former and 10 million of the latter a month. They're injecting $30 billion per month into the economy, which is now a lower number than it had been. They're tapering it down. By early March, it will be zero. So when the Fed is not gobbling up all these mortgage-backed securities, there isn't as much of a market for the mortgage-backed securities, which means mortgage lenders have to go and charge a higher rate because they can't go and sell them as easily. And so that's why the average, according to the St. Louis Fed, the average 30-year fixed mortgage rate today is 3.55%. It's up a half point since just December 23rd. I understand that was like less than a month and a half ago, less than 45 days ago. Mortgage rates have come up a half a point in less than 45 days. That's a big deal. And that's not it, because remember, over the next 5 weeks or so, the tapering will continue and then it will stop entirely. So if you have clients that are thinking about locking an interest rate, whether that's for a refinance or a house they're buying or whatever, or maybe they're locked now and they're wondering about canceling a contract, you need to tell them that their new mortgage rate is going to be considerably higher, and there's going to be a financial difference in whatever home they want to go buy next, or if they wait to lock their rate. The great news is 3.55% historically is a ridiculously good mortgage interest rate. It's insane. I would take it all day, honestly, but it's not as good as 3. And it's not as good as a 2.325% 15 year. 15 years are now up over 3% too. So there have been big changes in interest rates, and they're going to keep coming. They're going to get higher than that. So will we see 4? I think it's feasible. We could potentially get there pretty quickly. This, I think, everyone needs to be telling your clients about what's going on with interest rates. The Fed is not buying bonds and mortgage-backed securities as much anymore, and they're going to stop entirely. And mortgage rates are going to keep going up because of that. So that's the big economic talking point that I'd like for you to walk away with. For market metrics, it's record low inventory. For mortgage rates, it's the fact that they've already come up a half point. And I would not personally be surprised if they come up another half point by the time we see mid-March, because of that financial injection stopping. And by the way, there's the reason they're doing that. The reason the Fed is tapering off that program is because there's now too much money in the economy. That's why inflation has skyrocketed, and now that's causing other problems of its own. So the Fed's got to cool off their buying, so they're not pulling as much money, pushing as much money into the economy. They got to slow that down to help sort of quell the inflation, and that's also going to have the effect of cooling off the housing market. I do not think that is going to cause a crash in the housing market. I do think that that's going to take the extra 20, 30 grand off the table that people can just throw at a house. I mean, it's going to cool down some of the multiple offer situations and things, especially compared to last spring, which was ridiculous. I do not see that's not going to make more people sell a house. And we only have 13,858 of them available in all of Northeastern Illinois. So unless that's going to make people sell more houses, I don't see that causing a major shift in the market. I see it causing a minor shift. And I'm going to take a look at some of the questions and address some questions. Angela, I hope that answers yours. Julia, Fed purchases will end in April. No, they will end by early March. They didn't say a specific date, but I mean, early March, I'm just going to say before the 15th. So by the Ides of March, the Fed cash injections will be done. Then Angie, you said, how do you respond to people that are saying the market is going to crash, even though I just said that there is no imminent crash? I will not pretend to know everything about that. All I can do is work with the information available. I think a lot of the people that are saying that there's going to be a crash are saying that under the premise or the principle that the rate of how things have been going is not sustainable. And it's not. And it will not continue indefinitely. It can't. It just cannot do that, and it won't. But you can't tell when it's going to change. And a lot of the people that are saying that there's going to be a crash are saying that the piper has yet to come piping from all of the people that were being propped up financially by government stimulus, by extended unemployment benefits, by mortgage forbearance programs, things like that. And that there's obviously homes now back in the foreclosure pipeline. I've done the math. If you take all the homes that are in the foreclosure process nationwide and you put them all in the housing market, we're still not back to a balanced market. So something more than that needs to change. And obviously that's not going to happen. Most of the homes that foreclose never see the market before they foreclose. It's just a few of them. So I don't see that as a big change. Snow says, do we know what that means in real numbers? Today's rate versus new rate. So Snow, that's a fantastic question. And what I would do is I would say go and work these numbers at your price point, whatever price point or most of the clients are, or that are in your geographic area, and go and run a mortgage payment estimate at a 3.55% interest rate. Go run one at 3.05 and say a month ago it would have been this. Today it's this. And I'd give them another one that's a half point higher and say if it changed a half point in 45 days, and the Fed is going to do exactly the same thing for the next 45 days as they did the last 45 days, what stands to reason, we could easily see another half point increase. So here's what your payment would look like at 4.05 and 4.05%. And there's going to be a very big difference. And then you could even convert that to buying power. So you could say that's the same thing as if you financed an extra X amount of dollars today. So today you could buy, for your payment, you could buy a house for $320,000, but at 4.05% to get the same payment, you could only pay $300. So you're going to get more house today than you will literally just a month from now. And I'm just making up some numbers here, but those are approximate. But I would do that for your clients, especially buyers who are challenged with getting a home, and they may be saying, I don't want to pay 20 grand over list. Well, if you don't have something bought by a month or a month and a half from now, you're going to be paying 20 grand over list, except you won't even be able to pay 20 grand over list. Your payment's just going to be just as high as if you did. So you might want to go and get yourself a locked interest rate today. If I was on the fence, I would be hounding my loan officer. I'd be getting a contract, and I would be in there getting a rate lock right now, because there's not a question that rates are going up. A lot of times we're not sure about things, and we can't predict. The things that drive mortgage rates are changing, and they're changing intentionally. They're going to go up again. They're going to continue going up, I should say. And I would not be surprised if the average hits over 4 by March 15th. So run those numbers for your clients, put that together, play around with your mortgage calculator. Angela, I don't have the answer for that one. What was the percentage of foreclosures in January? I'm not sure if you mean the overall delinquency rates. You can find that, though. I know FHA publishes that data a lot. I believe Fannie and Freddie do as well, in terms of what are the overall delinquency rates. I don't know what they are, although I believe, based on what I've seen in the past, that they're actually pretty low compared to historical norms. And they most certainly are nothing like they were with like the Great Recession and things like that. But I don't have that answer. I'd say just Google that. You can Google the delinquency rates, and HUD/FHA for sure provides that for their loans, which are typically the highest risk. So usually FHA loans have the highest delinquency rate. Great questions, guys. I'm going to hang around here and keep watching for questions. Anything else that you've got? Did I answer all of them? Are those sufficient, satisfactory answers? You guys have follow-up questions? I'm just going to watch for a few more seconds here before we wrap this up. And then any other questions that you have after this, post them on the video here in our group, or as I mentioned, I'm going to put this video on YouTube. We'll make it public, so if you put some questions out there, I'll check with that too. Thank you very much for listening in. And remember, the upshot of today's conversation is housing inventory in our area hits another record low, and mortgage rates have come up a half a point in 45 days, and very possibly will raise another half a point in the next 45 days. Go do your best for your clients, and let me know if you have any questions. Great luck, everybody.